Of Erickson TV, courtesy with Lauren. Hello, Lauren.
Hey, everybody.
Hey, Lauren. Once in a while, I get this creative inspiration and try to be an artist, and so I do some art today. But this is actually really meaningful. One of the foundations of Erickson Wealth and Tax Management is to help clients grow their income, and so this is a chart that I want to credit to an article by Nick Murray that a gentleman named Mike Meccan put this together. And this is an illustration of two things. We're looking at a time frame of 2005 to 2012. So this is very recent history.
Right.
And we're looking at what's happened to bond interest income. And you can see it over those 7 years that has gone progressively down.
Yes.
Okay. And the red line is investors adding new money into bond funds. And that's progressively gone up.
Right.
So what's your comment about that?
Accurate, I'm sure, to the tenth of a decimal point these charts are.
Right.
But no, as a general rule, this is what's been happening. As investors get lower expected return in bonds, they put more and more money in.
Right. And
that's basically what's occurring.
So one of our, as I said, we really want to help clients grow their income, and this is definitely going in the wrong direction. So, now this next chart, which is interesting, is we're looking at a stock index measured by the S&P 500 equity index. And so there's other indexes. This is not the only stock index. So this is the same time frame, 2005 to 2012. And as you can see, dividends have generally, except for a little bit here, progressively started going up as a rate of return. But look at what the investors are doing.
Taking their money out.
Taking their money out. So my takeaway is, first of all, it's another example of investors exhibiting the wrong behavior.
Right. Exactly.
That's obvious. And then also, it's almost a guaranteed losing proposition if you go back to the interest versus not fleeing the stock market. Go ahead.
If investors were being mostly rational, these lines shouldn't really be going up or down much. I mean, they should be going up just a little bit over time, because just a little bit more money should be putting into investments accounts versus being taken out of accounts. There should not be dramatic drops and then dramatic rises for different asset classes. People should be keeping a fairly similar mix at any given time.
And the final takeaway is that one line that I haven't put there is the inflation line. And I'm going to do this here really quick here. So inflation line is something like this. And inflation line there. So these people that have invested for dividend yield, they're doing okay.
Yeah, staying above inflation.
And I try to do the same line, and this is a little harder because but it's going to be something like this. Right, the inflation line there. So these investors are not doing well. And we see this when you go to the grocery store and people that are living off of fixed income only. So when you want to look at investing for the long term and for retirement income, it seems very clear to us that having all of your investments in bonds is not a good idea.
Not going to work. And
part of your investments in stock indexes such as this, and by the way, there's other indexes that are having even a higher dividend yield, not just the S&P 500, makes prudent sense. Right. So thank you for watching this episode of Erickson TV. If you would like to evaluate your portfolio to make sure that you're maximizing your retirement income growth, please give myself or Lauren a call. Thank you very much. Bye now.
See you next time.